Hey, accounting students. This is our video lecture for chapter number 2. There's probably going to be 2 parts, so this is part 1 of 2. The title of our cooperation is Consolidation of Financial Information. In other words, the accounting rules we follow when one corporation acquires a controlling interest in another corporation. Back in chapter 1, we would have called this parent the investor corporation. But now, because we have more than significant influence, we have controlling power over the target or subsidiary. We don't call this parent investor anymore, yeah? Or the subsidiary investee. So now we're learning some new terminology. And the method, accounting method we use to account for purchasing that target corporation is called the acquisition method. And if you were taking this advanced accounting class 30, maybe even 40 years ago, you would learn a different method for acquiring a corporation called purchase or pooling, which older corporations still could be grandfathered in. And our appendix to chapter 2 covers those other methods, which you're not going to be responsible for. Yeah, so you don't need to read those appendices, but be aware of the term purchase and pooling method because some older corporations are grandfathered in using those methods versus the preferred acquisition method, which uses the fair value method to determine how much is being paid or how much is being acquired when you purchase a subsidiary. So let's take a look at some reasons why one business would buy other businesses. Here's some examples of recent acquisitions of a parent or acquirer purchasing the sub or targets. For example, if you were a Sprint cell phone user, well, you're not a Sprint user anymore. You're now a T-Mobile user. Yeah, I remember buying Fitbit sports trackers. Yeah, which was purchased now by Google, which they still sell Fitbit, but I think the main reason why they wanted to buy the Fitbit company is to move their customers to buy their Pixel watches. Yeah, Google Pixel watches. A lot of times, pharmaceutical companies like Merck and Johnson will buy smaller pharmaceutical companies because those smaller companies have been developing drugs that have a long life patent or being currently developed, whereas the older drug companies, the larger drug companies have patents running out. Yeah, so instead of just developing new drugs themselves, they will just buy companies that have those developing drugs. Yeah, so these are current examples, yeah, of mergers or acquisitions. Some of the basic reasons why you want to maybe have these purchases of subsidiaries. And for example, maybe you want to lock in your supplier or lock in places you want to distribute your product. So vertical integration, maybe a basic example would be petroleum, yeah? So let's see if I can illustrate this out here. So maybe you have some type of gas station way down here, the retailer, and they're buying their gasoline from some type of wholesaler. In turn, they're buying it from the refinery, and ultimately where the petroleum is being drilled and drilling exploration. So you could have one company doing all of these different activities, yeah, the so-called supply chain, locking in the supply chain. An example of this for petroleum would be a company like Exxon, although I don't think we have any Exxon gas stations here in Hawaii. Maybe we have a Chevron. Chevron does this. Or maybe you want to focus on a company that just sells gasoline. So maybe you drive into a gas station from Costco. Or maybe you just want to invest in a company that has exploratory drilling of petroleum. That would be, I remember doing a investment in a company called Apache. You know. Or again, you could have a company that wants to lock in their customers or lock in their suppliers, yeah, to buy those type of companies. Again, that's called vertical integration. Vertical integration. This reason here, cost savings, kind of ties into what they call economies of scale. Giving you an example, here in Hawaii, the recent merger of Hawaiian Airlines with Alaskan Airlines. Well, what they say is now Alaskan has really more routes yet they can fly, so-called increasing their market. But at the same time, they can save costs by eliminating a lot of the backroom operations. In other words, Hawaiian Airlines has an accounting department, and Alaskan Airlines has an accounting department. Why have two accounting departments where your technology using economies of scale can be all handled by just one accounting department? Yeah. Not increasing sales, but here reducing your costs. Let's see. If you're a bigger company, it may be easier to raise money, either selling bonds, borrowing money, or issuing out stock, or even using the subsidiary you just acquired, the excess cash funds you acquired in that sub, using it to pay off any financing costs you had just used to buy that sub. Or maybe you want to spread your risk by investing in a different industry. Sometimes they may call this conglomerates. One overall company purchasing companies in different industry. So if one industry goes bad, hopefully the other one will increase in value or at least stays constant. Yeah, it's not cyclical or seasonal. And of course, just expanding your business in general is a reason to purchase other companies. So recognizing when we need to combine, consolidate financial information. Definitely at the time you acquire a company, you need to know how to combine all this financial information together, the acquiring and the acquired company. And from that point on, if you have a continuing subsidiary, we'll learn how to report the consolidation for future periods in future chapters of the semester. Okay, the reasons why we need to have one combined set of financial statements. It's probably more meaningful, that's information, to the stockholders, to the creditors of the companies. And here we use the word fair a lot, yeah, in accounting. Fairly presenting the consolidated companies that are under that common control. Even though you have companies still recognized as separate legal entities, but because of that common control, it's probably more fair, more useful to have one set of financial statements whenever you need financial statements. So we'll go through the steps of how we combine information together to eventually prepare a financial statement. Let's move on here. Okay, so we need to look at the actual transaction that takes place to determine whether we got control or not. And from that point forward, now we need to consolidate the items from all the different companies. So one type of combination is called a statutory merger. Statutory meaning law, And the specific law most times we look at is not any accounting law, not any federal law, but it's state law where the companies are located, where the companies are incorporated, where the companies are organized or doing business. Yeah, we follow those states' merger laws, statutory laws. And a couple of different ways of doing this. Either the acquiring company is going to buy the assets of the acquired company and assume the liabilities of the acquired company. And then the acquired company is going to be dissolved, going to be going out of business, liquidated. Or another way, indirectly, of doing the same thing is to have the acquiring company buy all of the stock of the acquired company and then liquidate that acquired company. Here, they use the word dissolve a lot. Moving the assets, moving the liabilities of that dissolved company into the acquiring company. Okay? A little bit indirect compared to directly getting the assets and liabilities here. Let's see if I can illustrate this. Let's take a look at a white screen. White screen? Yeah. And my pen. No, that didn't do it. Where's my pen? Here is my pen here. Okay, so we have the parent or the acquiring corporation, and here is the target or subsidiary. And of course, all companies have assets and liabilities. And what our parent would do is pay the subsidiary or the acquiring company to buy the assets. Now we just combine these assets with the assets already owned by the parent, and we assume the liabilities with other liabilities we have of the parent. Again, we're paying directly to the sub. And eventually the sub, of course, will liquidate and distribute whatever proceeds they have left over to their shareholders, yeah, and thus dissolving the sub, leaving only one business here with more assets and more liabilities. Of course, whatever you paid here is going to reduce the holdings of the parent itself, yeah. So that was the first one. So let's see if I can clear my screen here and do the second one. So now we have a parent, and here is the sub owned by shareholders of the sub. And what we're going to do is not directly buy the assets and liabilities of the sub, but here the parent is going to pay the shareholder of the sub, and the shareholders are going to give the shares of stock of the subsidiary to the parent. So now there's a subsidiary owned directly by the parent. And so now we can kind of ignore this here. Keeping in mind, if you're issuing out stock here now, this shareholder will be a shareholder of the parent. So pretty much right away, we're going to liquidate this sub. Assets going here, liabilities being assumed by the parent, and thus eliminating again the sub, leaving everything with just one company. So the ultimate thing is we just have one company at the end in this so-called statutory mergers. Of the two different ways, maybe this could be simpler for the parent buying the shares of stock and, well, I'll take it back. The other way, buying the assets and liabilities directly could be simpler for the parent. Taxes could be different depending upon which of the two methods you use over here. But we'll save that topic for the tax class, the business income tax class. Okay, and that was statutory mergers. As compared to statutory consolidations. Ultimately, like a statutory merger, we end up usually with just one company. Let's see if I can illustrate this one again. White screen. Now, let's get my pen first, then white screen. So we have a parent and a subsidiary. And what we're going to do is form a new corporation. And either the shareholders up here and the shareholders up here would contribute their shares into this new corporation, taking back shares of the new corporation. Okay. So now this would be like a holding company owning the parent and owning the sub. Or, well, we'll do it just this way. Yeah. So now the parent can um, transfer assets, sub can transfer assets. Liabilities can be assumed from both corporations into the new corporation, ultimately dissolving the two corporations, only leaving the new company owned by shareholders of the old company. Okay. So that's one way of handling this statutory consolidation. Now, if you don't dissolve the two companies, in other words, you keep the three companies. Again, let me illustrate that again. My pen first. Pen. No. Okay, I got my pen and white screen. So here's that new company and eventually owning the so-called parent. Really, it's not really a parent anymore. It's another sub. This would be now the parent, yeah? And again, you're not going to dissolve the company, not going to dissolve the company. But now when you prepare a financial statement, you got to prepare it for the whole group over here. Okay? Not just individual three different companies. Sometimes they would call this company a holding company. It doesn't really have any operations. It's just holding the stock investment of the other companies that are operating companies. Yeah, that's when you uh, don't dissolve any companies. Just keep all the companies in existence. And another um, reason why you would have to prepare consolidated financial statements is if you have what they call a variable interest entity. And you don't have control through ownership of the stock, but you still have control through contracts between or among the different corporations or lease agreements among them. Okay? You're controlling those companies through these types of agreements. And we really don't get into variable interest entities in our class this semester. But if you want to know more, you can take a look at chapter number 6 in our textbook. Yeah, that we're gonna skip. Yeah, we're gonna skip it after doing chapter 5 this semester. So here's a summary of the different reasons for combining information together. Again, through a statutory merger, and what you're doing is acquiring the assets of the sub and liabilities and having the sub go out of business, leaving all this new stuff in the parent, that one company. Or here, again, statutory merger via purchasing the stock of the subsidiary and then liquidating the sub, moving all the assets and liabilities of the sub again into the parent. And then a statutory consolidation. The word consolidation has different meanings, but this is under the probably the state law, yes, statutory, doing this, setting up a new company and having all the other companies either invest their assets and have their liabilities assumed by the new company, or just transferring the stock of those other companies in exchange for stock of the new companies with the shareholders of the existing companies. And either dissolving the old companies, again, the effect is just like a merger, or keeping the old companies alive. Um, and then eventually preparing a consolidated financial statement among all of the companies you have. Variable interest entities, yeah, where we have a control of more than 50% interest. Again, that's going to be something that well, that's this last one down here, yeah, that we're kind of just briefly covering here in this chapter, but more so in detail in chapter 6 that we're not covering. We're assuming in this chapter, at least, we're going to acquire 100% of the target company. So we don't need to account for yet any minority interests. We'll save that for a future chapter. Again, control, when we do need to consolidate information, is when we have more than 50% controlling interests, usually through stock ownership. And we learned, again, reviewing back in chapter 1, when we have less than 50 but more than 20, the assumption is we have substantial influence, and we had that other methods of accounting to use. So going through the rules, that we need to use will depend upon whether we're going to dissolve the old corporations, the sub, or keep them alive, yeah, not dissolve them, which is going to be more work because now you have to deal with 2 or more companies and put all of their numbers together. Um, for those of you who took the governmental accounting class in a previous semester, if you remember, we talked about fund accounting. Let's see if I can illustrate that out here. Um, we had different funds for the different departments, and then we would consolidate those, including the enterprise type funds like utilities, together eventually to prepare a government wide financial statement. Government wide. And the only time we prepare a government wide financial statement is when we need financial reports. Even though we still have fund accounts, fund financial statements, we don't do any detailed accounting work here in the government wide because there's no accounts except for preparing a government wide financial statement. All the detailed funds, all the detailed transactions are handled by the funds, yeah, by the enterprise accounts. So likewise, when we prepare a consolidated financial statement, you only are doing this here. And the intermediary step to prepare that big financial statements is through the use of worksheets. Yeah, here, working papers. And not really posting, journalizing and posting to accounts, but really just journalizing and posting from or to working papers to get that consolidation here. Yeah, consolidated financial statements. So if we're gonna dissolve the subsidiaries, we're gonna assume it's gonna be done right away on the date we actually acquire the subsidiaries. If you wait a few days or a few months, you're actually gonna cause yourself more work, at least accounting work, yeah? Because now you have an accounting period of income and expenses to account for. Whereas if you do it right away, any new income, any new expenses are going to be reported by the continuing business. And if you have continuing operations of the sub, then you're going to have to keep track of those transactions in each company. Yeah, more work. So let's go through the rules here for acquiring. Again, we're using the fair value, not the book value. Well, you start off with the book value, but you're going to either increase it or decrease the target company's assets and liabilities to its fair value. And we're going to assume that we have control. This parent has control, 100%, at least in this chapter. And we do it by specific assets. Even though you keep the subsidiary alive, not dissolve it, we still have to probably identify the whole value of the sub by looking at its individual assets and identifying any undervalued ones, identifying ones that are not even on the official records of the sub. And that goes true also for liabilities of the sub. Assets are kind of easier to visualize, either increasing or decreasing in value compared to book value. But the same is true with liabilities. For example, if you if the sub borrowed money a while ago at a high interest rate and it stays at that high interest rate, but I assume this liability at that high interest rate, but now when the time I assume it, the general interest rates are low, that means I can use cheaper money to pay off those expensive liabilities. So the liability has to be revalued. And likewise, the opposite can be true. Borrowing at low interest rates, but then eventually you acquire at a time when the interest rates are high. Again, the liability has to be revalued to its fair value. And ultimately, if the amount you pay is over the fair value of the identifiable net assets, we're going to have that infamous goodwill to be recorded on the acquirer's books. Or if for some reason what you paid to acquire the sub is less than the, if the amount you paid, is less than the identifiable fair value, net fair value of books, of assets you acquire, then the difference is a bargain purchase. And a bargain purchase is going to be recorded as income, revenue. Now, how can you report income at something at the time you buy something? Well, because maybe the seller was desperate and they're willing to reduce the amount they are going to accept over the value, the fair value again, of the net assets we're acquiring. Then we're actually going to have to report a gain at the time we acquire that sub, that target. In the calculation of what we're buying, we need to determine how much we're paying, here called consideration transferred. And it could be a whole bunch of stuff we're paying. Any asset, of course, the easy one to identify is cash we're paying either to the acquired corporations or the shareholders of the acquired corporations, or any liabilities we're assuming of the target corporation. Or maybe we, the acquiring corporation, are issuing out new liabilities, either giving a note payable or issuing bonds, and then even using the proceeds of this borrowed money to pay, again, either the target or the shareholders of the target. And of course, what most people visualize is issuing stock to the acquired um, company or the again shareholders of the acquired company. So all of this added together, is the total amount we're paying. Keeping in mind here it mentions something called contingent amounts eventually that need to be paid. So if we're not sure whether we acquiring this new business is going to make us more profitable, we can set conditions, future conditions, and if met, at that time we can pay extra. But we need to determine the probability of that condition being met and the possible amount we need to pay in the future, and adding that amount to all of the other amounts we're paying right now. Yeah. So hopefully it's pretty easy to determine this amount. I think most times in textbooks, we're just given the probability as a percentage, whereas in real life, you're going to have to use your experience to determine what's the probability. Again, all of this being recorded at the time we um, pay, all of this being paid, yeah, to buy the new company. So that's one big figure, consideration transferred. Okay, and then we need to determine uh, what we are buying, either the assets of the target company or the stock of the target company. Your assets, if reduced by any liabilities assumed, there's your net book value, or increasing this to the fair value. Yeah, increasing this to the fair value. So the fair value of what you're buying is going to be compared to, here in the previous screen, how much you're paying. And we could have a difference between the two. Here they talk about determining fair value, possibly what the willing buyers and sellers are willing to exchange it for, yeah, market value. To me, it's pretty close to this replacement cost, what a willing buyer is willing to pay a supplier of any asset you're trying to get the value for. I think you learned in intermediate accounting another valuation method is cash flow, net cash flow, present value. Yeah, take a look at the assets and how much of that investment asset is going to be providing a cash flow in the future for so many years, and discounting it to the present value. I guess this is something you would also learn in a finance class, yeah, to determine the value, current present value of an annuity. And we have possibly three possibilities when we compare those two broad amounts. Again, consideration paid is one amount, net present value, fair value of the assets you're acquiring. And if they're equal to each other, you don't have to use this screen here. There's no goodwill or no bargain purchase. But if what you pay, consideration transferred, is greater than the fair value of the assets being acquired, then the excess is goodwill. Or if just the opposite, what you pay is less than the fair value of the assets, the difference is a bargain purchase, and it's going to be recorded as revenue, a gain. So let's see if we're going to go through an example here to demonstrate all of this amounts being calculated. Our example is BigNet. This is your parent. This is the acquiring company. And here's what they're going to be paying. $550,000 in cash. And we're going to issue out new, not treasury stock, new stock, 20,000 shares. And it has a par value. Remember, par is an artificial value of 10, but it's really worth $100 per share. So you record the capital stock at 10, common stock at 10, and the difference of $90 per share would be additional paid in capital for a total of 20,000 shares. So that's all of what we're giving up to acquire our target called small port. And here we're told that small port is going to go out of business, yeah, leaving only the big as the remaining company now with more assets and assuming more liabilities of small. And we're going to consider what we're giving up. Consideration transferred is equal to the fair value of what we're getting. So there's not going to be any goodwill. There's not going to be any bargain purchase. So let's take a look at more numbers here. This is the amount we're giving up, yeah? This 50,000 of fair value. We're getting assets we're getting, and also what we're giving up. So we're given two columns here. One is the book value for big, our parent, and one is the book value of small, our target subsidiary. And here for small, the amount for fair value of the same assets and also liabilities. So current assets the same, computer and equipment, here it's worth more than their book value. So that's why, well, we're paying $600,000 worth. Yeah, not just 400,000. And let's see, 11,000 more in software value as compared to book value. And here's an asset that's not even on the books of small. The value of their customer relation through contracts worth 700,000. Even the liabilities have a different value. Let's see, it went up in this amount here. That could mean that at the time they borrowed this money, interest rates were higher than the current interest rates right now. Yeah, so the buying power or the amount here is higher. So total, this is the net assets we're acquiring of small, and this is also what we're paying in value by big. And because they're the same, we're not going to have any new goodwill asset or don't have to recognize any purchase gain, bargain purchase gain. Let's see if we continue on the next screen. We now look at the equity. Remember assets and liabilities on the previous page, and here the book value of equity and small on the second page. So I think this includes the new shares of stock. I take it back. This is before issuing the stock, additional stock. This additional capital is before issuing the new stock. Retained earnings and the income and expenses of both companies. Keeping in mind that eventually when we combine the two companies together, the combined companies is only going to report this income and expenses and this dividends, because all of these amounts here for the sub or the target is going to be closed out into the retained earnings. And all we do is kind of cancel out the retained earnings when we combine the two companies together. Okay. So we're going to assume that first we're going to dissolve small. And then the second assumption is we're going to keep small as a separate subsidiary. Yeah, we don't liquidate it. So in this example, we're going to dissolve small. Again, we look at the fair value of what we give up or what we acquire and compare the two. And at first, we're going to assume it's the same. So here is the journal entry that big is going to record when acquiring a small, and where small is going to be dissolved. And this is at fair value, yeah, of small. Again, this is what big is reporting. They're acquiring fair value of current assets, the increase of the computer and equipment, also increasing by 1.1 million more of software. And this was zero or nothing on small, but now we're recording the fair value. Even the note payable has increased, was 200 as book value. Here's the cash we're paying. Big is paying small. And here is the 20,000 shares at par value. And then the additional paid in capital. Again, notice total debits equal total credits. If it weren't so, then we would plug in more debits. That would be goodwill. If we need more credits, that would be a bargain purchase gain revenue being credited. Again, small will go out of existence, just leaving big with these new assets, liability, and additional equity. Of course, less cash, yeah? by big. So let's change the facts. Let's change the facts in this situation now. We're going to pay more cash. Everything stays the same, but we're paying more cash, up up to 1 million now versus the 550,000. Same amount of shares being issued. The total consideration has increased. And you compare that to the net fair value of book assets being acquired, and there's a missing 450,000. So now we gotta record goodwill. Taking a look at the journal entry, same debits except for this last one here, yeah? Same credits except cash, there's a missing zero here, has increased to 1 million. To make your debits equal credits, the difference is goodwill, yeah? Excess proceeds being paid over the net realizable value, including this liability and netting the assets, comes out to this missing amount we're plugging in to balance our debits and credits. Of course, debiting is an increase to an asset, yeah, goodwill. And as you learned in previous accounting classes, it's an unamortizable asset subject to impairment, yeah, write downs. Let's change the facts again. This time, the amount we paid is less than the fair value of assets being acquired. There's a mistake here somewhere. Let me go back in the previous screen here. Our journal entry here doesn't actually balance. But it's saying here in the description, the total amount being paid is $2 million. And it should be all stock. Big conveys no cash. So this journal entry is wrong here. Let me scratch out what should be eliminated. If I can find my pen. Here's my pen. Cash should not be here. It should be zero. And really this 550,000 is moved down here into this gain revenue, yeah? Okay, so now we're balancing if I scratch off that cash. The only thing being paid is stock to the target or for the target. And again, to balance our debits with the credits, we got to plug in that missing amount. Revenue recorded with credit. Let's stop here. And then go ahead and continue into the second video where we'll finish off this chapter number 2.